This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's get to the chart deck. Listeners, you're going to find the download link to the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Chris's picture that says looking for the downloads. Eric, what a week in crude oil. Let's talk about this chart and how did the EIA inventory numbers come in?
EIA printed a drawdown of 1.3 million barrels on crude oil inventory, but that was really a 3.3 million barrel drawdown after you consider that they pilfered another 2 million barrels out of the Strategic Petroleum Reserve. Now, they're still drawing down the Strategic Petroleum Reserve and increasing the rate at which they're doing so, 2 million barrels this week versus 1 last week, at the very time that they promised us they were going to be refilling it. Surprise, surprise. Cushing, Oklahoma, building 541,000 barrels, gasoline building 1.7 million barrels, distillates drawing down 1.2 million barrels. U.S. production ticked back up to its plateau level of 12.3 million barrels. So far, we haven't seen any print higher than 12.3 post the COVID pandemic. Let's see if we can get there next week. Tape action. Well, prices were dropping on Wednesday before inventory and continued to drop after inventory. Then on Wednesday evening at the futures open at 6 p.m., we had what looked like just a monster stop clearing run. At least as of yet, I have not heard any fundamental news to justify why it happened. But there was a sell-off all the way to a 63 handle. I believe the low print was 63.68 on June WTI crude oil. What drove that down? I'm not sure. It was back up above $66 within minutes, so it does appear to have been some kind of stop clearing run. Is that going to be the final run, or will there be still lower lows on Thursday? That remains to be seen. The next major support below that would be at 59.40, 5940. That's the 100-month moving average. Seems like an unthinkably long way down, but boy, the move we had on Wednesday evening's futures open was an eye-opener. Maybe there's more to come. Maybe that's it. We'll see what happens.
Yeah, Eric, it was quite a surprise drop for me. I was really watching that support line around $72. I thought that there was every reason for it to offer at least a reactionary bounce. But in the last two trading sessions, just relentless selling, just blowing through all these key support lines. We clearly got a bounce off the previous low. It obviously poked just slightly below, hitting some stop losses down there. But what will be really interesting at this stage is whether crude oil can get back into the 70s. If we see that crude oil spends day after day here, basically rolling over in what was previously a support line, now acting as overhead resistance, we could end up still seeing crude oil stuck down in these bottom end of the ranges. I wasn't expecting this degree of weakness, but this is a lot of technical damage, and it's going to take weeks to repair this technically. I think oil bulls are going to need to have a more realistic expectation that this isn't going to really turn in the short term, and that we're going to have to see something develop in the latter part of the year. All right, let's move on to the S&P 500. Erica, what are you thinking here on these markets?
No real change from last week. I still think the bear market bottom is not in yet. I think it's a credit event that's got to take us to the new stock market low. And I think we're headed there probably by the end of the year, maybe into early 24, somewhere south of 3,000 on this S&P before this is really over. I won't be at all surprised if we first rally up to the 61.8% fib level, which is 43.09 on the S&P. If that happens, I'll short it there with a stop maybe 100 points or so above that and see what happens. But I don't think it's over yet.
All right, Nick, I want to get you into this conversation. On page 3, we have the S&P 500 support resistance levels. What levels are you watching, bud?
Yeah, Patrick. So spot right now on SPX is 4090 approximately. There's a call wall above at 4,200, which has acted as significant resistance. There's a put wall below at 3,900. Interesting to note that it lowered from 4,000 down to that level. So now we're at 3,900 on SPX for the put wall. The expected move right now for the May 19th OPEX, which is 2 weeks away and change, is 110 points in either direction. So the upper expected move is right to that resistance area of 4,200. And the lower expected move is below the key area of support at 3980 approximately. So key resistance again right now is 4100 or just above us, which we broke below yesterday post FOMC. Above that is 4150, and then that key area of resistance 4200, which is also the expected move, upper move, for 2 weeks out. The key support areas are just below at 4050 and then 4000. If we break below 4000, chances are we end up pushing pretty hard and fast down to that put wall area of 3,900 or so.
Nick, it was interesting that you were talking about that 4,000 level, because on page 4, I put that 200-day moving average, the ascending trend line, and even the Fibonacci retracement zone, which is not drawn on there, all converge around this 4,000 level. And the way I look at it, even though the market reacted on the FOMC with a little bit of weakness, and we still have the jobs numbers in front of us, what will be really interesting for me is, will the bulls be able to dig in and hold the support line? If it does, there's always that chance that we're going to have that one last push up to even potentially break above 4,200. But in order that scenario to happen, I think this support line you were just talking about does have to hold. And I don't think it's going to take more than a few trading sessions for us to find this out.
Yeah, I think if we hold this, 4,100 area and bounce back above it and push above 4,150, I think there's a good chance we see new highs. But again, tonight we have Apple reporting. That should be the main catalyst going forward. If Apple has a poor report, I expect the market to sell off and test that 4050 area and possibly the 4,000 area. And that could be the short-term catalyst to the downside. Obviously, in addition to the speculation that we have some more regional bank failures, perhaps.
All right, Nick, let's take a look at the QQQ and the support resistance levels there, because, like you're saying, Apple is coming out. It's one of the last major big ones to report here. What are the levels on the Qs you're watching?
Yeah, so right now the spot price on Qs is around 317. We have a call wall above at 325 and a put wall just below at 310. The implied move for the May 19th OPEX is about 11 points. Upper expected move is 328. Lower expected move is 306. Key resistance right now is just above at 320, which we poked above for about a day or so, and key support is at 300. And again, like you mentioned with Apple, if they perform well, obviously we're probably going to see some upside in Qs. But if they don't perform well, we'll probably see some downside back to that 300 area or so. And thus far, we've noticed that, the mega caps like Microsoft, Amazon, Google, Meta, they've done pretty well overall, save for maybe Amazon pulling back after their initial pop off their earnings. If Apple does well as well, then we'll probably see some more upside. And again, the reason being is that looking at these companies, they're all individually kind of conglomerates now, tech conglomerates, if you will. And so they have such massive size in the market that, even, 4 or 5 of them doing well can carry the market higher, even if everything else does poorly. So I'm kind of short-term bullish cautiously, but longer-term bearish.
Right, Nick. So one of the interesting observations, S&P 500 is trading already back to the lows of last week. But what's interesting about the NASDAQ is we're still on the NASDAQ 100, 200 to 300 points higher than last week's low. That just continues to show the relative strength that the NASDAQ is having. On page 6, I have the Russell 2000 futures, and what we can see with the small caps, they're trading at not only the year-to-date lows, but only a stone's throw away from the lows of last year. That weakness continues to be evident on the small caps. The breadth of the market continues to be incredibly narrow. And just exactly like you're saying, those mega cap tech names are just keeping not only the NASDAQ up, but also keeping the S&P 500 at more elevated levels relative to something like the small cap index, which is showing some very broad weakness. The one thing I wanted to also highlight on page 7 Ireland is that regional banks ETF, the KRE, and just continues to show how very weak regional banks are. And this is a huge drag on the small caps, as many of these regional banks are in the small cap index. And that's something Chris Whalen was talking about as well, that we continue to see that this is where the weakness continues to be. Clearly, this was not, the pressure has not been alleviated on this in the post-FOMC period. So it'll be really interesting to see whether or not small caps lead the way and break to new lows and really start to signal that something more ominous is underway.
Yeah, Patrick, I'm in agreement. I mean, this morning as we speak, PACW is down, 37%, and WAL, Western Alliance Bancorp, is down about 14%, with the rumors that PacWest Bancorp is going to try and seek a sale. So, after the failure of First Republic, this could be the next bank to fall, perhaps, and that's going to cause a drag on the regional banks yet again, right? So, what you may want to look for in this kind of bloodbath of a market in terms of the regional banks is, maybe pick a few names that you think may survive, and the ones that get thrown out with the bathwater, so to speak, might be the ones to be bought.
Yeah. Well, let's move on page 8. I have the chart of the VIX, and we finally have volatility coming slowly back into the market. We're not yet above the 20 handle, but certainly off of those very low depressed levels of volatility that we were at last week. What are you watching here on the VIX?
Yeah, I'm watching for that key area of 20 or so on the VIX. If we get above 20, I think we can make a push toward 25. That would probably coincide with some news, like another bank failure, perhaps. But again, right now, we're expecting movements intraday of about 1.25% roughly. And realized volatility has been actually lower than implied volatility thus far. So let's see what happens going forward. But again, volatility suppression seems to be occurring on the longer term options. We're not seeing as much activity on the 30-day average options, and we're seeing a lot more activity on the ZRDTEs, which I think is still suppressing volatility. So it's possible if we get below that 40-50 mark on SPX, we see a sharp push down to 4,000. If we break below that, then we flush even harder. But again, if we get back above where we are right now to that 4,100 area roughly, and kind of cascade up to 4,150 or so, volatility should remain suppressed. But again, I think it's going to have a lot to do with both the regional banks as well as Apple's earning report tonight.
All right, let's move on to the dollar index. Let's start with you, Eric. What's your thinking here on the dollar?
No real change from last week. We're smack dab in the middle of a consolidation zone, and so there's no real trade signal here until we get a daily close below 100. So far, no sign of that happening.
Yeah, on page 9, I have that dollar index, and you can see how it's trading right along those lows. The ECB just came out, and it did have the U.S. dollar react a little bit off of its low levels. Whether the U.S. dollar holds this support line or not is going to be critical, because a dollar breakdown that starts, let's say, a move under 100 on the Dixie would spur a euro above 112 and certainly add fuel to something like the gold chart we're about to talk about, which could use that as a tailwind for a huge breakout. Watching what the dollar does here next is going to be critical.
All right, guys. Now, moving on to gold, we have the gold futures chart on page 10. What are you guys thinking here as we push toward all-time highs?
I am surprised and impressed by the resiliency the market has shown in holding round number support at 2,000. Each time we dip down intraday to 1985, I was thinking to myself, okay, here we go. We're starting a correction down to 1,900 or so. And maybe I'll get a chance to buy some more gold on the cheap down there. Well, then whammo, I turn around and the market's back over 2,000. And now, as I'm recording before the open on Thursday, gold spiked all the way up at the 6 p.m. futures open on Wednesday and technically hit a new all-time high, although it only lasted a few seconds. It hit 2085. I won't be surprised if we're already at new all-time highs above 2085 by the time our listeners hear this podcast. Certainly, it seems like the market is making an attempt at that Wednesday night. So check your own quotes, see where we stand. But as of Wednesday evening, an attempt was being made on the all-time highs. I thought it was going to take all summer before this breakout breakout happen to new all-time highs. And of course, there's still plenty of room for this to fail here and reverse lower. So, it hasn't happened yet. But if we get an honest-to-good breakout, let's say well above 2100 in the next week or so, that would be super bullish long-term. It would say that the market was able to slice through this major resistance of a new all-time high without much resistance whatsoever. It only took just a few weeks in order to get through it. So let's see what happens, though. It hasn't happened yet, and we're lining up a lot of dominoes here. So let's see what next week brings.
Yeah, interesting that gold did make that punch for a direct test of the March 2022 highs, and teasing everyone with the idea of whether or not gold is going to break to an all-time new high. I mean, this trend is very distinctly bullish. Higher highs, higher lows, every dip is being bought. But really, the big tailwind, in my mind, has been the relative weakness of the U.S. dollar. And so, like I was saying earlier, I think the U.S. dollar is going to play a really important role in determining whether the gold is going to make the breakout now. I mean, I think certainly when we look out a year or two, I feel pretty comfortable leaning into the idea that gold will be at all-time highs and running. But whether it does this move here in May and June of this year, I think is going to be all dependent on what the reactions are here in the currency markets. Major overhead resistance level, major highs. We're going to find out very quickly whether gold is able to make that big move. Nonetheless, I wanted to just wrap things up with a quick look at the uranium futures chart. And what's interesting is that uranium has been incredibly quiet for almost an entire year, just bouncing around between 48 to 53 on the U308 contract. And we finally are getting a breakout out of that trade range. Now, one day doesn't make a new trend, but it'll be really interesting to see whether uranium is starting to move. And it's interesting that it's happening because we see so much broad weakness in the commodity space, and it seems like uranium might be marching to the beat of its own drum. It'll be interesting to see whether this breakout actually sticks.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.